Greetings. Today is Wednesday, April 1st, 2026, and it is entirely possible that the short-term market correction is over. However, I'm going to show you some interesting economic charts that gives me some pause. That said, if you haven't already connected with me on LinkedIn, scan the QR code and send me a connection request. I do these videos somewhat monthly. But on LinkedIn, I do post economic commentary a little bit more frequently, as well as on our blog post. That said, let's go ahead and dive in. On the screen, I've got a monthly candle chart color-coded to coincide with our VSI. You can see that the month of March is right here, a pretty volatile month. Keep in mind the candles are color-coded based upon the reading on the VSI on the first of the month. The VSI did deteriorate all the way to a sell signal. It is still on a sell signal. So from our standpoint, risk is still very elevated. We're going to talk a little bit more about that. But first, let's switch and look at a daily candle chart for the S&P 500. And I want to show you a couple of things. First of all, from my perspective, this top is very rounded. That is one concern. By the way, it would be wise for me to pause and say, when we look at stock charts like this, these are not predictive. We are looking at a stock chart because it shows us what has happened. And through history, we can also say that there is suggestions. For example, when we look at this stock chart for the S&P 500, I would have argued, and I did argue, that this area, this top blue-gray area or zone, if you will, might allow the S&P 500 some support. It obviously did not hold. And so the next level, these lows from midsummer, late summer, early fall, and then early November, these levels might very well serve as support because they kind of coincided with the 200-day moving average that also didn't hold. So we did violate those, but yesterday, the last day of March, we did see a fairly significant rally in the S&P 500. However, if you look at the RSI indicator, which I've added to the bottom pane here, this tells us that down here is what we refer to as an oversold reading. In other words, the market has gone too far too fast. When you see that, some bounce can, expected is not the right word, but it's not unreasonable to think that we might very well see a bounce when we get down here. But you can't use that as a timing device. It doesn't mean anything other than the fact that it has gone too far too fast. If we switch the screen and look at the equal weight version of the S&P 500 using the RSP ticker symbol, RSI was also oversold, and you can see it was oversold a little bit longer. However, if we zoom back out, look at where the market has found this short-term bottom. If this bottom holds, it kind of coincides with the late November 2000 or early November 2024 highs and this big zone here. So that's why we look at technical analysis and the history of a stock chart, because these zones can indeed offer some guidance as to where we might be going. But you can't make decisions off of that. It's just information. Now, if we look at the Magnificent Seven, we're going to use the MAGS, M-A-G-S, the ETF, as a proxy for the Magnificent Seven. And you can see the Magnificent Seven has, you could argue, was even in a bear market, being down almost 20%. Also experienced a little bit of a rally. But if you remember the math on how the S&P 500 is calculated and how heavy of an influence the Magnificent Seven has, when the Magnificent Seven has come down like this, it's could very well be a challenge for the broad S&P 500 to rally, simply because there's so much what we refer to as overhead supply in these Mag 7 stocks. If we switch and look at small cap, look at where we found support, right at that 200-day moving average. But this, I would argue, is a little bit more orderly, and this might actually be a little healthier than the larger company stocks, which I would contend is a good sign economically. As we have been saying for quite some time, if the only thing that is working well are those big mega cap stocks, that is not a healthy, robust, thriving economy. If we get a lot of participation from the smaller companies, that is a much healthier sign of the economy. That said, I thought I would also highlight some of what I'm seeing underneath the surface. Again, here is the RSI for small companies. Notice it did not actually hit that oversold reading on the RSI. The other thing is down here, this is called MACD, and I see a very, very minor positive divergence. This is a sloping positive, this is sloping negative. That is some encouraging signs about when you look underneath the surface. Now, if we look at the NASDAQ index, that's again a very heavy drawdown because you can see the highs there was back in October. Late October was the high in the NASDAQ. So the tech sector has really been struggling for a while. However, as I talk about in my book, Evidence-Based Investing, you really can't use bonds as your safe haven because of what we're experiencing in the bond market. So this is AGG, the aggregate bond ETF. And what I want you to see is there's been a fairly steep sell-off. It's only 3%. But remember, bonds are arguably, and I would argue, inaccurately considered a quote-unquote safe asset. There's no such thing as something that is safe. There's risk in all of this. And given the environment, I do not believe that we can use bonds as a safe haven. You can see that fairly steep sell-off. We're now below the 200-day. We're below the 50-day. The bond market is not entirely healthy. We're going to circle back to that in a couple of minutes. However, let's zoom out with AGG, and this is now going back to 2021. We had that steep sell-off in 2020 and 21, and this is now what we refer to as a very long base, but we can't break out of this base. And as a matter of fact, the bonds are struggling and heading in the wrong direction. So again, from my standpoint, bonds could not really or should not really be used as a safe portion of your portfolio. Remember, if you have studied the stock market and asset allocation and things of that nature, going back to Markowitz and Fama and French and all those guys that came up with a modern portfolio theory, the theory is that bonds are less volatile than stocks. That can be true. That is not always true. And it certainly is once again evident, as the late action suggests, that bonds are not necessarily safe. So that said, let's look at some year-to-date stats. Now, down here, we've got the Magnificent Seven. Again, year-to-date, the Magnificent Seven through the end of March is negative 11%. The NASDAQ is negative 7. You've got the S&P 500 negative almost 5. But look at the RSP. The equal weight version of the S&P 500 is negative 50 basis points, or 0.5. International is still positive, but what I really want you to see is there's this negative slope to all of this except for metals and mining and commodities. We're going to come back to commodities in just a minute. If we now look at the sectors of the S&P 500, the S&P 500 is broken down into 11 different sectors. And again, you see a negative slope, a negative bias on all of these lines except for this guy. And this is energy. Now, this is going to be interesting to show you. This is a weekly candle chart for the XLE, the energy sector. And what I'm trying to show here is that for quite some time, energy as a broad sector has just moved sideways and then it rocketed out. Here's the daily chart for energy, and you can see this sideways pattern on energy really wasn't doing anything for quite some time, and then it just rocketed out. When we talk about energy, we know that it is heavily influenced by oil, and oil has obviously spiked with this war in Iran. But look at when we really started to see the energy sector move. This is before the war in Iran started. So did the energy sector foreshadow a spike in energy, and did it foreshadow the war in Iran? I don't know. But you can't look at this and say energy is doing well simply because of the war. It has actually started to move out prior to that war starting. And as we have discussed the last couple of months, one of my concerns has been that metals and mining and commodities and energy, those sectors have been leading, and they are historically, not always, but historically late cycle leaders. So that has been one of my concerns. So the month of March ended with a fairly strong rally in the broad markets. And on top of that, if you look underneath the surface, there are a couple of encouraging signs that a short-term bottom might very well be in. So we could make an argument that the pullback that we've experienced these last 2 months might very well be over. However, if you followed our work for any length of time, you know that we approach things with a weight of the evidence approach. And one of the things that we use is our proprietary VSI. The VSI is comprised of both short-term and long-term signals, and I've got those signals on the screen right now. And you can see these are our short-term. They're all on a sell signal. Our long-term signals are all, except for one, on a sell signal. So our composite is still telling us that risk is still very elevated. Now, that said, let's switch and start to look at some of the economic data. And on the screen now is a chart that I showed you last month. Last month, we had talked about the fact that fourth quarter GDP was a positive 1.4%. If you remember from that video, I indicated that that figure is approaching what I would refer to as stall speed. That's running the risk. That's really getting close to dipping into a recession. Well, since then, we have had a revision on fourth quarter GDP, and it is now only 0.7%. So the economic data, as measured by GDP, is pretty weak. And so that is definitely a concern. However, as you also likely know, I prefer to look at GO, which is the gross output. And you can see what I'm looking at here is a little bit of a sideways pattern in terms of gross output. The economy, as measured by gross output, has really not grown, really hasn't shrunk. It's really in a very a finely balanced economy is a good way to say that. Now, the next update on gross output will be on April 9th. I'm really going to be interested to see how does that data change. Now, the problem with looking at economic data is the economic data historically is looking in the rear view versus the stock market is looking out into the future. So we cannot be surprised if the next update on gross output is actually a lower bar, but that is historical. And so if we see lower economic data as measured by gross domestic product and gross output, that doesn't mean a recession is coming. It very well may explain why 2025 was so problematic for the majority of stocks. It might also explain some of what we've experienced the last 2 months. But again, nonetheless, I'm going to be very interested to see what the latest date is, or the latest data is, on April 9th. Now, I have been saying that this is one of my biggest concerns economically. This is job openings. The good news is that we did tick back into this channel, but again, the recent update was again fairly negative. This is the rate of change, the 12-month rate of change in job growth. You can see trending in the wrong direction. But then when we overlay a 10-year moving average on that, what we can see is when the rate of change goes below the moving average line, a recession is not far around the corner. And look what's happened not too awfully long ago. I guess a couple years ago, we did dip below that. So far, there has been no declared recession by the National Bureau of Economic Research, but this is another data point that suggests, well, maybe we've kind of been experiencing a recession underneath the surface, at least in some of the economy. Certainly not the AI industries, but that might very well explain some data points. This is some encouraging signs. I thought I'd share one good news update from economics. This is housing starts. We were in a negative trend. It looks like we might have broken that downtrend. So I would say this is encouraging. Now, the next thing, and maybe the last thing that we'll discuss today, is the Federal Reserve's recent action to hold interest rates steady, as well as the 2-year yield. Now, if you are connected with me on LinkedIn or you've heard some of the podcasts that I've been on, you have heard me say that I thought the Federal Reserve should have cut rates. And a friend of mine recently asked, why do you think the Federal Reserve should have cut rates? And I would argue the jobs market. The jobs market has been pretty weak. And if one of the mandates for the Federal Reserve is the maintaining full employment, jobs market is pretty weak. So that to me suggests the Federal Reserve should cut rates. The other mandate that the Federal Reserve has is to maintain stable prices. That's a fancy way of saying inflation. I don't think inflation is a major issue right now. Yes, the price of oil and the price of gasoline is going to have at least a short-term impact, but ultimately I really don't think inflation is a very big problem. So when you weigh all of that out, I'm thinking the Federal Reserve should have cut rates. They obviously don't care what I think. They're doing their own thing. They have a lot more data than I do, but that's my thought process. But then I remembered to look at the 2-year yield. This 2-year yield, as you can see on the screen, is in the blue line. The blue line is a 2-year yield that you can get on the U.S. Treasury, and the green line is the Fed funds rate. And you can see a fairly tight correlation between those two. So let's now zoom in so we can see the current data a little bit better. Again, the blue line is the 2-year yield. The green line is the federal funds rate. They have kept that rate steady. That's why it's flat right here. But what's happened to the 2-year yield? It is actually bounced off what I would argue is support and is moving higher. So there is an argument that the Federal Reserve might actually be raising interest rates in the not so distant future if this correlation remains. So I would argue that we are in a fairly finely balanced economic environment. I do see some signs that perhaps the short-term bottom is in and we can begin to take risk again. However, we never know what is in store, and we are going to follow the evidence that we see, and we are always going to be focused on defending the hard-earned capital of our clients first. Obviously, if you have any questions, by all means, send me a DM. Until next time, thanks for watching, and I hope you have a wonderful and very blessed Good Friday and Happy Easter.